MSCI, its business model, fundamentals, valuations, and reasons I bought it. Um, if you're new to investing in personal finance and you don't know a lot of investing concepts, that's okay. It will be near the end of the meeting, so you can leave if you want, or you can just stay there and how do you learn some things? So yeah, hold on. Actually, uh, since there's a lot of new people today, can everyone start a video? I'm going to screenshot this meeting. Yeah, can everyone please start a video? It's okay if your video isn't working, but okay. Okay then, share this then. Oh wait, hold on. Yeah, okay. So on three, two, one, cheese. Okay. Yeah, thank you everyone. You can um yeah, you can continue starting your video if you want to, but it's nice to see everyone's faces. So now let's continue. Okay. Yeah. So now I'm just going to introduce the Hoperation Fund to anyone who's new. Established on May 18, 2023, the Hoperation Fund is a nonprofit organization with two main missions. Number one, here at the Hoperation Fund, through fundraising, receiving public donations, investing the donations in the stock market, and donating the profits from the stock market, we are dedicated to aiding and donating to nonprofit charities or organizations, helping with problems such as environmental protection, education in underserved regions, children and women welfare, and other causes. Our second mission is to fill educational gaps by hosting monthly meetings, hosting active discussions about investment and finance, participating in reading clubs and lectures. We equip students and adults with essential knowledge and skills in personal finance and investment. These areas are often overlooked in traditional school education. So we have four parts of the Hoperation Fund. The three original parts, fundraising, investing, and donating, are where we fundraise and do marketing to raise capital and donations, invest the donations into the stock market, and then donate the profits from the stock market to charities while returning the original donations to the donators. Our fourth part, though, is education. This is where we again participate in monthly meetings. I will host lectures, or maybe in the future we can invite other people or professional investors to host finance and investment lectures. We host reading clubs, um, active discussions, etc. Okay, so now let's move on to talk about the Hoperation Fund investment portfolio. The return of the Hoperation Fund in August was 2.11%. The balance at the end of July was $14,120 approximately. At the beginning of August, we received $400 in donations, and the final balance at the beginning of August was $14,522. The final balance at the end of August was $14,829, as the investment return in this period was 2.11%. So below is a screenshot of the Hoperation Fund investment portfolio. You can see we have 6 sectors with stocks in each sector. We have technology sectors, insurance, finance, retail, healthcare, and energy. So you can see the stocks in the Hoperation Fund are still pretty diversified. I don't understand this. So the year-to-date returns since the beginning of this year for the Hoperation Fund was 32%. So as you can see, this is much more than the year-to-date returns of SPY and QQQ. In August, we initiated the new positions MSCI with 4.5% of capital and RSP with 14.2% of capital. As you can see here from this screenshot of the Hoperation Fund. Later on in this meeting, I will talk more about MSCI, it's the company, its details, and why I invested in it. Um, and I posted a recent video on my YouTube channel, Olivia AI and Investing, 1 or 2 weeks ago about why I bought RSP for the Hoperation Fund investment portfolio. Later after this meeting, you are welcome to watch it. Note though that this screenshot is as of August 31st. So far in September, we at the Hoperation Fund have sold RSP to raise more capital for hedging. So here are some comparisons of the monthly returns of the Hoperation Fund investment portfolio, SPY, and QQ. You can see here plotted in this graph are the cumulative returns of the Hoperation Fund, SPY, and QQ. And in this table here are the monthly returns and total returns of the Hoperation Fund, SPY, and QQ. So I will give you guys a moment to look at this. Note that the return since its inception, since June 2023, of the Hoperation Fund is 62.9%, or about 63%. Again, this is huge compared to SPY and QQ's returns. Okay, so does anyone have any questions about this or want me to repeat something? Okay, it's okay. Later on, I will talk about some financial knowledge and stuff. And if anyone wants me to like slow down or repeat some information, I totally can. So don't be afraid to ask me. Okay, so now let's move on to the market analysis section of this meeting. So first of all, let's talk about the market direction. For the short-term direction of the market, it's currently bearish. As you may have noticed from the market, has anyone like noticed the returns of SPY, QQQ recent stocks? Okay, yeah. So the short-term market direction is bearish. For midterm, the direction of the market is a steady progress from bullish to bearish, in my opinion. However, the long-term market direction is bullish. So for position sizes, if you have an investment portfolio, and if you're investing in short-term stocks with like high returns, I would recommend personally a position size of no more than 40% for stocks, and I would recommend buying more bonds. Yeah, Claire, do you have a question?
What do bullish and bearish mean?
Oh yeah. For Sometimes those investment terms you might find in like lectures and stuff. Bearish means the market is doing badly, like it's going down. It means like investors are like think the market is going to go down more. Um, bullish is usually good, like it's always good. It's like the market is going up. Yeah.
Okay.
Uh, yeah, you understand, right? Yeah. Sorry. Sometimes like I will talk about an investment term or something, and if you don't understand, yeah, don't be afraid to ask me. Okay. So about the market direction, you can see here, short term it's more bearish, midterm it's like a progression from bullish to bearish. Long term, I would say it's still bullish. Of course, if your investment portfolio is like for long-term investment, like composed of like good quality stocks, I would still recommend holding it. But if you are investing or trading for short term, I would recommend having stocks occupy no more than 40% of your position size or investment portfolio. So for market emotion, you can search this up too. The CNN Fear and Greed Index is now at 39. So the CNN Fear and Greed Index is this number that goes from 0 to 100. The closer to 0 the number, the more fearful the market is. And the closer to 100 the market, the more greedy it is. So right now, the number is 39. So you can see that's much closer to 0 than 100. So the market right now is comparatively pretty fearful. Mm. For market valuation, the market is also slightly overvalued. For example, the estimated S&P 500 P ratio is 28.26. The 10-year Treasury yield is 3.716%. It's okay if you don't understand what the 10-year Treasury yield is or a P ratio is, but a P ratio is basically just this ratio for like price over earnings ratio. It's a good indicator of like of a stock or ETF's like value in the stock market. So as a general rule, the reciprocal of the 10-year Treasury yield is about the true P ratio or the true value of the market. So the reciprocal of 3.716% is about 26. The P ratio of the S&P 500 right now is 28.26 though. So, two or so points might not seem like much, but the S&P 500 P ratio right now is actually 10% more um than what the treasury yield indicates or what the true P ratio or value indicates. Okay, so this is just like some market analysis to like keep in mind. Now let's move on to our lectures today. Today I'm going to talk about the compounding effect. So you guys know the Mona Lisa, right?
Yeah.
Yeah, really famous painting. So in 1540, King Francis I of France paid $20,000 for the Mona Lisa from Leonardo da Vinci. Now the Mona Lisa though is worth almost $1 billion. So I typed it out for you guys to visualize $20,000 for a painting that's now worth about $1 billion. Like that's a great deal, right? It can't get much better than that. However, if King Francis I of France had invested $20,000 into the stock market or something equivalent of like this of the S&P 500 was by during the 1500s, he would have $1 quadrillion today. That is 10 to the power of 15, or 1,000,000,000,000,000,000,000,000. So if he had invested $20,000 into the stock market with about average 10 to 15% returns back in 1540, he would have this much money today. So what this shows how powerful the compounding effect is, as over time the returns of the stock market are compounded. The longer you hold an investment of stock, the more returns it gets for you. This also shows how valuable it is, or how much returns you can get from investing in the stock market. I'll show the chat. Yeah, true. Like some people said, like $20,000 back then was still a lot of money, but it was definitely not worth $1 billion back then. And so yeah, then that investment is is worth like even less money. Okay, so the compounding effect is illustrated even more powerfully in this story. So Sam and Susie pretend they're two people, are friends from high school and college. They both learned to save for the future at a young age. After graduating from college at 22 years old, Susie worked hard in a job and started to save money. At the beginning of each year, she put $2,000 in a tax-deferred account, such as a Roth IRA, and invested in a fund earning an average of 10% return every year. Due to events, however, Susie stopped saving after the age of 33, having invested for 12 years, putting an additional $2,000 into an account with an average return of 10%. Sam, though, started saving later in life. After college, he decided to spend the extra earnings from his job on luxury cars, clothing, nightclubs, overseas vacations, and other entertainment. He started to get serious about investing at the age of 34, investing $2,000 per year in the same tax-deferred account as Susie for 32 years, at the same average 10% return every year. So keep in mind this. Susie started investing at 22 years old for putting $2,000 into an account for 12 years, earning an average of 10% every year. Sam started to invest at the age of 34, investing $2,000 per year for 32 years at the same 10% return. So when Sam and Susie retired at age 65, they both compared their tax-deferred investment accounts. They made the following table on the next page. So what can you find from this table? Okay, you can see here the total returns on money Sam and Susie ended up with. Sam ended up with $442,500, and Susie ended up with $993,300. So I have a series of questions for you guys. You can blurt this out or raise your hand. So question number one, how much money did Susie put into her investment account by age 65? Like, how much money did she put or invest into her account? Does anyone want to answer? Chloe?
$24,000.
Yeah. She invested for 12 years, putting $2,000 each year. So yeah, $24,000. So how about Sam? And you guys can just blurt this out actually.
32,000.
32,000? Close. Um, does anyone else have a different answer? It's okay. Okay. Does anyone answer? Yeah, you guys can see from this table what age they started investing in, the amount they saved, the total money they ended up with. Okay, so Sam, he invested for 32 years, with $2,000 every year. So that's $64,000. Sam invested $64,000, while Susie only had $24,000. So how come even though Susie put in less than half the money Sam did, why did she end up with more than 2 times the amount of money Sam did?
Because she saved money longer.
Yeah. Oh yeah. For anyone raising their hands, it's okay. You can blurt it out now. Yeah. The the question, the factor isn't how much money they put into their accounts or the returns they got from those accounts. It's how many years they invested. So you can see Susie started saving money at age 22. Even though she stopped at age 33, age 34, she had put in money earlier. And so as time went on, her money got compounded, like earning higher and higher and more returns. While Sam invested more, he he invested at a later age, and he didn't have enough time for his money to compound. So again, this story illustrates how powerful the compounding effect can be, and especially how powerful time can be in the compounding effect. The more time you have, the much more returns you can get. So someone asked me, under Sam, how does $2,000 become $4,620? Basically, he invested $2,000, right? And then he had a return of 10%. So those $2,000 became $2,200, according to this chart. And then he put in $2,000 more, so that became $4,200. Again, he had a 10% return, so that $4,200 became $4,620. So yeah, Hubert, does that answer your question? Okay. Also, clear all drawings. Okay. Can you explain in more detail, please? Okay, sure. So you see it for Sam. I'm just gonna draw here. He, at the beginning of that year, he put in $2,000, right? In the story, he had a return of 10%. So that $2,000 became $2,200 because he had a return of 10% or $200. So that was at the end of the year. At age 35, he put in another $2,000. So he put in $4,000 total. So now the money in his account is $4,200. Following? Yeah. So then that $4,200 earned even more returns to $4,620. And then you can see every year he earned more returns. Like here it's like $2,420. Here it's like 3,000 maybe. Here it's like he earned 3,000. And up until here, he he earned like 7,000. So yeah, as Dr. Zhang said, my dad said, um, Warren Buffett had a quote, like all you need is wet snow and a really long hill. So the long hill, yeah, means time. With long time, the compounding effect can result in amazing results. Like it's like a snowball effect, right? If you go snowball down a hill, it becomes bigger and bigger. As time goes on, your returns from compounding get bigger and bigger. So does anyone have any more questions? Oh yeah?
I'm pretty sure my dad had a question.
Oh yeah, sure. You're welcome to say it. Wait.
My dad wants to know if you share the portfolio earnings. Holdings, I mean.
The Hoperation Fund holdings.
Mhm.
We share part of it to like we share part of the Hoperation Fund holdings. At the end of this meeting, I can like email you. I can share part of the Hoperation Fund's investment portfolio with you guys. But yeah, after the meeting, sure.
Okay, thanks.
Although for confidentiality to make sure um um for confidentiality or for private purposes, we share like part of it. But yeah. Claire, do you have a question?
What if you invest in stocks and then you lose money?
Yeah, that happens. Yeah, that's why it's important, not just to know like how powerful investing in stocks and how great it is, but also how to choose the right stocks. Like here at the Hoperation Fund, later on I'm going to talk about the new position we bought and like all of the details about why we bought it, from the business model, how it makes money, it's like its leadership to its fundamentals. Yeah, but yeah, so that's why it's important to like learn how to choose like the correct stocks or anything, how to look at the companies. But you shouldn't be afraid of like losing money, because there's always a risk you'll lose money. Like in the stock market, there's no 100% guarantee. Um, so yeah, in this example, we're assuming they earn like a stable amount of around of an average of 10%. In real life though, you're going to have ups and downs. Like one year you might earn 20,000, the other you might lose like 5% or 10%, and then you might earn 7% or then lose 10%, earn, I don't know, 30%. Which is like, although like the results vary with like different stocks. Some slightly more stable, some are more volatile. So, but in this example, we're just assuming they earned a constant like 10%. Because once you hold a stock for a very long time, um, the ups and downs get like smoothed out sometimes. But yeah, that's a good question. Yeah, all of these are like great questions. Okay, so does anyone have any more questions about this? So in the previous example, we talked about the value of time in the compound effect. Um, how over a long time, your returns get compounded and they build up more and more. However, in this example, I'm going to talk about the importance of returns. In the story of two savers, they had the same returns, right? But what if they had different returns? Even like slight returns, slight differences in returns can add up to huge differences in returns. So consider two investment portfolios, Portfolio A and Portfolio B. Portfolio A has a compound annual growth rate of 15%, while Portfolio B has a compound annual growth rate of 17%. If each portfolio starts with the same initial investment, let's say $100, so what will be the percentage difference in your total values after 30 years? Does anyone know? You guys can guess. Like just if you have a guess, it doesn't have to be too close. You don't have to do like some sort of detailed calculation, but if you have a guess, you can raise your hand. So or so here's actually the formula for calculating the amount of money you get. So if say your initial balance is $100, then the return after year one will be $100 plus $100 times the return rate, let's say 15%. Or in other words, $100 times 1 plus 0.15, and then you get 115. You can do that same with year two. 115 times 1 plus 15% is $132.25. Or put simply, the formula for calculating the CA for calculating the balance after year n is 100 times 1 plus 15% to the power of n. So in this case, for 30 years, you would plug in 30 for n, so it would be 100 times 1.15 to the power of 30, or 100 times 1.17 to the power of 30. But anyways, does anyone want to take a guess? Seriously, there's no like shame,
Maybe
like
like 80%.
80%? Nice. Yeah, yeah, that's a good guess. Yeah, thanks for answering. Hank said 68%. Yeah, that's a really good guess too, yeah. Anyone else want to guess?
200%.
100%?
200%.
Oh, 200%? Interesting. Okay. So the answer is actually this much. So you can see 225%. Cool. So you can see from this graph, I plotted the annualized compound rate of 15% and 17%. You can see while the differences doesn't seem to be much, like in year 0, year 5, year 10, year 15, after 30 years, the difference is almost double. About, let's say, like 80% maybe.
Yay.
Yeah. So about 70-80%. You can see a small 2% difference in CHR can lead to nearly double the final balance after 30 years. Yeah. So that's like amazing, right? How just a tiny difference or under the compounding effect through lots and lots of years of compounding, this can be huge. This can lead to huge differences in returns. That's why it's important to like be very detailed in picking the right stocks and try to get as high returns as possible. Because even like small differences, if you invest for a long time, those differences can be the difference of like earning a lot of money or earning just a little bit of money. Okay. So does anyone have any questions about the compounding effect? You can see how powerful it is, right? Yeah. Yeah, that's why, in my opinion, investing in the stock market is the best investment you can make. So now let's talk about the rule of 72. This is just like a really quick, like mental math kind of way, to calculate how many years it will be until your money doubles. So here's a question. If I have $10,000 and the interest rate is 5%, after how many years will my $10,000 be doubled to $20,000? You can use the previous formula I mentioned, the one here, to calculate it, where the money you end up with, $20,000 in this case, equals the initial money, $10,000, times 1 plus the rate. Here, the interest rate is 0.05 to the power of n, or the amount of years. Oh, Heidi said 20 years? Yep. The answer, yeah, close. The answer is, well, you guys can see the answer here, actually. The answer is 14.2 years. Ah, okay, what? Okay, anyways, alternatively though, we can use a much quicker method to estimate n. Like, who wants to solve this equation? So that is the rule of 72. The rule of 72 is a fast estimation of an investment's doubling time, given the interest rate. So you can see from this equation, the doubling time equals 72 divided by the rate of return. So to answer a question, we can estimate like this. The doubling years equals 72 divided by 5 equals 14.4 years. So everyone got it, right? You guys got it? Okay. So my second question is, how long would it take to double your money if you had a 10% rate of return? According to this formula.
7.2 years.
Yeah, yeah, great, Claire. So the actual number of years is 7.27 years, but according to the rule of 72, it's about 7.2 years. So you see really close, like a difference of 0.07 years. So here's a table of more examples. You can see the annual interest rate, and the the answer according to the rule of 72, and the actual number of years. You can see it's like a really close estimate, just to like quickly calculate. Okay, so now let's move on to another concept I want to talk about today, the time value of money. So, a question, would you rather have $1,000 today or $1,000 after 1 year? And everyone should like answer this question, right? Yeah, you can blurt it out. You just
Today. Probably $1,000 after 1 year. Wait, are you saying like after investing for 1 year you have $1,000
no, it's like $1,000 today or $1,000 like I'm going
in
to
a year?
yeah. It's no investment.
$1,000 today. Yeah, $1,000 today.
Oh, I lost brand. Yeah. You would all rather have $1,000 today, right? It's obvious. Inflation plus if you had $1,000 today, you could invest it in the stock market, right? So again, I'm just going to talk about a quick formula for calculating the time value of money after inflation. Um, It's actually about the same equation as previous. So assuming the inflation rate is 5%, then $1,000 worth of goods today will be priced at $1,000 times 1 plus 5% equals $1,050 after 1 year. So $1,000 today, according to that equation, equals $1,050 after 1 year at an inflation rate of 5%. So $1,000 today, of course, couldn't could buy more things than $1,000 after 1 year, basically. So here's the formula. The future amount equals the current amount times 1 plus r parentheses to the power of n, where r is the interest rate and n is the number of years. So this equation actually looks like super similar. It's about the same equation as the previous ones, right? Yeah. Um, you see this 1 plus parentheses 1 plus r to the power of n. This is the rate at which the current amount or the amount of money increases. Um, where you can see 1 plus the interest rate to the power of n is the the rate compounded, or in this case, like an exponent in number of years. So you can also find it with the equation, the current amount equals the future amount divided by 1 plus r to the power of n to find um, the value of the money after a number of years. So this is a really important equation, actually, not just for calculating like value of money after inflation. Um, so you should remember this. Okay. So does anyone have any questions so far? Okay. Before I talk about like my like the new positions in the Hoperation Fund and why we invest in them, I'm just going to review something. If you're if you're new to investing in general, or if just to refresh your mind. So what are stocks? Stocks are basically pieces of companies. When a company goes public, you'll see this term a lot sometimes, where they announce like they're ready to like sell shares of the companies publicly. The owners transfer shares of the company to the public in an initial public offering or IPO. After the IPO, the stocks are traded in public. By owning stocks, an investor owns part of the company, including the fortunes of the company. These these can be good or bad. Also, shares of common stocks grant the shareholders rights, such as the rights to influence the company's policies and directions through votes at the annual shareholder meetings. Note that some company stocks have two classes though, such as Google. One class of the shares grants the shareholders rights. Another class doesn't grant the shareholders rights. For example, in 2014, Alphabet, which is Google's parent company, split its shares into two classes. GOOGL with an L had retained all of the rights, and GOOG without the L did did not have shareholder voting rights. So that's just a bit of information. So now you know what stocks is. We can compare it to to other major asset classes. Here you have 5 major asset classes. The stock market, we're gonna use the S&P 500 to represent that. Gold, cash, real estate, and bonds. Since 1928, stocks have returned 9.9% annually, gold 5% annually, bonds 4.6% annually, real estate 4.3% annually, and cash 3.3% annually. Actually, that's like inflation, but whatever. So you can see here the difference between the stock market and the four other major asset classes, right? How, however, you might just think, oh, there's not that much of a difference. But really, have you noticed the scale of this graph or this chart here? Actually, this is like on a logarithmic scale, I think. Up here, difference is from 10 to 100, but here it's from 100,000 to 1 million. So you can see, while like cash is somewhere according to this graph at like I'd say like 3,000, 4,000. Real estate is at like 7,000. Gold or bonds are like 8,000 and gold is around 10,000. The stock market after so many years is at almost $1 million since 1928. So you can see how massive the difference is between the stock market and the four other major asset classes. However, holding stocks isn't that easy. As you can see here, you only think there's like tiny little dips or stuff, but actually these dips are huge percent changes. You can see the bear markets of 2000, 2008, 2022. This tiny dip actually is like tens of percent. So while because of the scale of this the particular scale of this graph, while these little dips might not seem like much, these are actually huge dips in which most investors would sell their shares like early around the bottom of these dips and lose money because they were so afraid that the stock market would collapse. Because these dips are actually huge, like huge losses. That's why holding stocks, you might think, oh, let me just hold this for a few tens of years and it'll be good. It's actually a really hard process, especially if you're in the middle of this giant bear market where you have pressure on all sides. Like everyone is broadcasting on like the media that the stock market is gonna collapse. Blah blah blah. Someone lost most of their money in the stock market, blah blah. Everyone is so afraid. Like that's a lot of pressure to sell. Yeah. Do you have a question? Spend 1,000? Oh, that's it.
Does cash represent inflation?
I think so. Anyway, this is just like I found cash technically decreases with value over time, but yeah, this 3.3% is inflation. Yeah. And this is actually supposed to decrease. Yeah, good point. Okay, does anyone else have any more questions? Ah, okay. Yeah. Oh, notice this picture doesn't adjust for inflation. So, um, so yeah, um, cash technically should be decreasing. Yeah, that's a good point. This picture doesn't adjust for inflation. Okay, so now let's move on to talk about why we invested in MSCI. Um, Also, we're near on the end of time. I will probably go over time talking about this. And if you're new, a lot of these concepts are definitely like not going to be familiar, especially if you're new to investing. And such as fundamentals, different ratios and stuff. But that's okay. Um, you can switch it up. You're welcome to stay here, or you can leave right now if you think this won't be too much of a help, or you can just stay here. Um, a lot of the ratios and stuff you can search up like later then. I think there's a recording so you can like look at this later. Um, or can you ask me later after this meeting? But yeah, let's talk about MSCI. MSCI are one of the Hoperation Fund's new positions. Um, provides critical decision support tools and solutions for the investment community to manage investment processes worldwide. Yeah. First of all, I'm going to talk about the business model of this company, if you don't know. Because before you buy a stock, the most important thing, besides its fundamentals, is to understand how it makes money. So MSCI um, makes money by providing investment decision support tools, um, risk management solutions, analytics and stuff, and many like mutual fund managers, investment companies. Many of these finance people are customers of MSCI. MSCI is also a major beneficiary, which means it has gotten a lot of profits from the shift from actively managed investments to passive investments. Basically, from actively managed mutual funds to ETFs or index funds. MSCI has three main segments it makes money from: the index segment, the analytics segment, and the ESG and climate segment. The index segment makes up 56% of revenues, the analytics segment makes up 24% of its revenues, and the ESG and climate, where it gives like ratings for businesses, like um of like how well you're like concerned with environmental protection, that makes up 11% of revenues. MSCI's clients come from asset managers, hedge funds, um, assets owners, mutual fund owners, insurance companies, wealth managers, corporate advisors, investment companies, etc. MSCI has also a superb, an amazing 95% customer retention rate, and most of its revenue is subscription based, meaning making its earnings very predictable. Usually, the stock market tends to give higher valuations to companies with high growth predictability, as they are usually more stable. MSCI Inc. has earned its wide moat through its successful index franchise, monetized through subscriptions, asset-themed fees, and transaction royalties. Management expects the company's revenue and generally to keep growing at low double-digit rates over the long term, with operating profit margins staying in the high 50s. So it's estimated here to have revenue growth rate of in the teens, 20s, etc. About the teens, 20s. MSCI also has a few risks though. MSCI has concentrated customers. For example, BlackRock, the largest asset manager in US, represents almost 50% of MSCI's asset-based fees, which limits MSCI's price power. Generally, if most or a lot or a big portion of a company's revenue comes from one company or a few companies, That makes it slightly riskier because if the company or companies leave, then most of its profits will be affected. This also limits MSCI's pricing power. They can't as easily bargain with BlackRock. However, a good thing is that MSCI sales are diversified, with 45% coming from the US, 38% from Europe, the Middle East and Africa, and 17% from Asia Pacific. When these non-US regions experience bull markets, MSCI sales have the potential to grow significantly. Here you can see a pie chart of MSCI subscription run rate by the area world. Okay, so does anyone have any questions so far for this? Okay then. So let's move on to talk about the management. The CEO of MSCI, Henry Fernandez, has served since 1998. So he's worked in this company as CEO for more than 2 decades. That makes him very experienced. He knows this company very well. He has a stake of almost $1 billion in MSCI, or 2.7% of the company. All of the insiders total in the company own 3.2% of MSCI. MSCI also has a very sustainable competitive advantage. It's a leader in the index market with pricing power, and it has a very strong moat. Due to a networking effect, it's very hard for its customers to switch to another company just because, this new company has slightly lower costs. Um, this is due, let's just say you're this tiny little company starting out and you give like ratings, financial advice, tools, investment tools, and analytics. No one's really going to believe you. Like, they're not easily going to switch to you and be your customer because you you don't have that trustworthiness. They're not going to believe you. Like, even though I know your prices might be slightly lower, they would rather stick with MSCI because MSCI has been here for a long time. It's very trustworthy. They know its tools are good. And also, even if just one customer switches to you, um, due to the networking effect, it's going to be hard for like the other customers to switch to you. Therefore, the customers in MSCI are very loyal. They have a 97% revenue retention. Um, to prove my point, in the past 10 years, the gross margin, which is a good sign of a company's competitive advantages and moat, is greater than 70%, and the ROTC or ROIC keeps on increasing. So it's like MSCI is also in an attractive end market and rides on macro trends. It benefits from the macro trend of passive investing, especially investing in ex-US markets and ESG. Again, MSCI has a pretty good healthy balance sheet too. It has an interest coverage of 7.7. Generally, the higher the interest coverage, the more likely it is to pay back its debt. Its net debt over free cash flow is 3.5. That's pretty high, but again, it keeps on decreasing. So generally, the lower the net debt over free cash flow, the better. And you can see from this graph, then the net debt over free cash flow keeps on decreasing. Right. The goodwill over assets is 53.3%. This is high, but it is still pretty tolerable. The debt over equity ratio, since MSCI has like a considerable amount of debt, its equity is actually negative. However, it has bought back a lot of its stocks to become treasury stocks. So if we add that as equity, um the debt over equity ratio is 0.7. But again, this company has a very high moat. That's why it takes on more debt because it knows it will pay it back probably. Its current ratio is 0.96. Again, for companies with very strong moats, they tend to take on more debt because they know they will have like pretty stable earnings and they will be able to at some point pay back that debt. Its quick ratio is 0.84. The capital operation, for capital operation, the CAPEX, basically the amount of capital it invests in getting more like equipment, or like getting more assets, maintaining those assets over sales is 0.8%. Its CAPEX over operating cash flow is 2%. So clearly MSCI has super low capital intensity. Like it doesn't spend a lot of money in like getting like new tools or anything because it doesn't really need them. So for capital allocations, ROIC is 24.5%, still pretty high. Generally, as a rule, I like it around or above 30%. ROE is 19.8%. Its profitability, its gross margin is super high, that's really good. 82.1%. Its operating margin is 53.7%. Its net profit margin, 43.8%. Free cash flow margin, 45.7%, and free cash flow over net income, 110%. Okay, does anyone have any questions for me so far? Or you want me to repeat a slide? Okay. Oh yeah, it's okay if like you're new to investing and you don't really understand a lot of the things I am talking about. That's perfectly okay. Um, but over time, hope like everybody can like learn more about investing and choosing stocks. Um, yeah, the important thing is to like participate in discussions, learn more, read more books, and listen to more lectures and stuff. And yeah. For the stock-based compensation of MSCI, it's 7.4%. So generally, the less stock-based compensation, the better. Um, Stock-based compensation is where like the company gives its employees stocks of the company in exchange for like when the company gives its employees shares of the company, kind of like besides paying the money, they also pay them with stocks. So, however, when you're paying your employees those stocks, the stocks of the company can get pretty watered down. So, um, for the for the growth, the revenue growth in the past 3 years is 13.5%. The EPS growth in the past 3 years is 21.3%. The expected revenue growth in the next 2 years is 10.5%, and the expected EPS growth in the next 2 years is 11.4%. The PEG is also 3.96. For dividends and yields, the dividend yield is 1.1%. So it's a pretty at least a pretty good dividend yield. Its dividend um YOY growth is greater than 20%. You can see like its dividend amounts are steadily growing. Its payout ratio is 42.8%. Its shareholder yield is 2.4%. Its earnings yield is 2.7%, free cash flow yield 3.0%, and buyback. Yeah, it does buy back some of its stocks, so yeah, that's pretty good. Because when a company buys back its stocks, or shares of its stocks, that means like there's less shares in circulation, which so each share is worth more. For valuation ratios, PE is 37.5, PS is 16.4, the PE over free cash flow ratio is 33.6, the EV over free cash flow 36.8, and the EV over EBITDA is 33.2. So is the P ratio is pretty high actually for the stock. It's 37.5. But I believe that it's a really good company. So while the P ratio is pretty high, it's kind of slightly overvalued. However, it is a good company though. So, in my opinion, it's a fair price. Okay, so, okay, does anyone want me to repeat something? Okay. Um, so now let's move on to the valuation of MSCI. So here's just like bit of Python code for calculating the valuation according to the 10-year discounted cash flow method. If you don't know what a discounted cash flow method is, you can find it in a video on my YouTube channel. Over here, I can copy and paste the link if you want. Okay, here, top here. Hold on. Oh yeah, speaking of which, for oh, Heidi, you asked what the PG ratio is, right? Hold on. The PG is like basically like the P, except it takes into account like the growth rate of the earnings. So it's like more like I guess it can sometimes be like more of an accurate measure of like uh the P ratio because it takes in like the growth rate. Hold on, everyone. Oh yeah, here's the link to my YouTube channel. You can talk more. You can watch it later. Um, you can watch it later. It's like about um a valuation method called the discounted cash flow or DCF method. So this time I used a 10-year DCF method. Generally, for general companies or stocks, I would use a 5-year discounted cash flow method. However, their earnings for MSCI is pretty stable, so this time I used the 10-year discounted cash flow method. So from this, you can see the stock's intrinsic value is 529.39 per share. Um, Again, though, valuating stocks, using and like using this method, this is more of an art than like a scientific method. There's no exactly like way you can, just not an exact way you can, like you can like do it, and like even like small changes in like the even small changes in like numbers can affect the value or the valuation you calculate by large amounts. So this is just like a general like overview, like not general overview, like a general estimate of the stock's intrinsic value. So here I calculated 529.39. Anything around that though is okay. So you can see from this, you can see from this screenshot, I bought MSCI at $559.85. However, again, this is around the intrinsic value I calculated using the discounted cash flow method. So again, anything around that is okay, and I believe I bought the stock at a pretty fair price. Okay. So here, this graph, I plotted the P ratio, and the EV over a bit. So, so here you can see like the P ratios changes over time, as well as the EV over a bit ratio over time. So, so you can see from this graph that the P ratio as of now, from 2020 to 2022, 23-ish, is comparatively lower than than this time period. However, through the long term, especially before 2020, the P ratio is average slightly higher on the higher side. So through this graph, though I only put it here so you guys can like see it and make your own like and determine your own opinion, or your own like, or decide on your own if the stock is slightly overvalued or undervalued. Um, this graph is just for you to like decide your own opinion. So yeah, that's it for my review on MSCI, the reasons I bought it, etc. But does anyone like have any questions or want me to like repeat a slide or anything? Okay. So now I'm just going to like do a kind of walkthrough on how to how to purchase stocks. So if you're like new to investing and you have a like Fidelity account, here's just like how you can buy an ETF for stock. So step one, you log into Fidelity, of course, enter your account, and here from the screenshot, you can click the trade tab as shown below. Once you click that, it will open a trade window. You can input the following information: the symbol SPLG, the action, select buy, input the quantity 1, select the market or the order type, in this case market, and select on the open or date. So previewing the order. So once I've inputted the information here, you can see what it looks like. If you want to buy fractional shares though, you can click the View Simplified Ticket. Then you'll see another pop-up. In this simplified ticket pop-up, as window as shown on the right, you can buy fractional shares. So as before, input the symbol of the stock or ETF that you want to buy and click the buy button, and then the dollars button, and input how many dollars you want to spend in buying the stock or ETF. As I show on the right figure, I input $442.20, which means that I want to spend $442.20 to buy DIA. Click the market button, which means that I want to use the current market price to buy it. And then you click preview order, you go through it again, and you click the buy. So does anyone have any questions about this? Although of course this is a recording, so you can look over this after this meeting. Okay. So actually that's it for today. This is the end of this month's Hoperation Fund investment review. I hope everyone learned a lot from this meeting. Um, and again, thank you for coming and taking the time to come to this meeting. So yeah, uh, Heidi Truman said, "What is the best beginner investing book so I can learn about investing more?" Uh, if you're asking me, after this meeting, if you can you can email me, and I can see if there's any investing books or anything and send you them. However, though, I would really recommend attending a reading club. There we will read a lot of investing books, too, and those can be really helpful for investing. So yeah, okay. So overall, um, thank you guys all for coming to this meeting. Does anyone have any more questions? Okay, then. And thank you all and have a good evening then. Bye.
Bye.
Bye.